Something happened in the markets today that I want to walk you through very carefully, not because it is a disaster, not because the world is ending, but because what just happened should not have happened, at least not according to the way most people understand markets. Gold fell, silver fell, oil went up, and the combination of those three movements at the same time tells a very specific story about what is happening in the global financial system right now. Most people are looking at the prices. Very few people are looking at the mechanism behind the prices. And the mechanism is what matters, because markets are not driven by what people think should happen. They are driven by liquidity, interest rates, capital flows, and positioning. And when those things change, prices move in ways that look completely wrong on the surface, but make perfect sense underneath. So let's walk through this slowly, because once you understand this, you will start seeing markets very differently. Let's start with what looks like the paradox. Normally, when there is geopolitical tension, when oil is rising, when inflation fears are increasing, gold should go up. That is the textbook relationship. That is what history says. That is what most investors expect. But instead, gold dropped. Silver dropped even more. Oil went higher, and the dollar stayed strong. At first glance, that combination does not make sense, but markets are not reacting to headlines. They are reacting to capital flows and interest rate expectations. And this is where most people misunderstand what is happening. When markets become volatile, when multiple asset classes start moving at the same time, large funds do not sit there and calmly rebalance their portfolios over months. They get margin calls, they get risk limits triggered, they get forced to reduce exposure. And when a fund needs cash quickly, it does not sell the worst asset in its portfolio. It sells the most liquid asset in its portfolio. The thing that can be sold immediately with a buyer on the other side. And in most institutional portfolios, gold is one of the most liquid assets they own. So when funds lose money in equities, bonds, currencies, or derivatives, they often sell gold not because they hate gold, but because gold is liquid and easy to sell. This is called a liquidity event, not a fundamental event, and this distinction is extremely important because a liquidity event pushes prices down temporarily. A fundamental event changes the long-term direction. Most people cannot tell the difference between the two. Now let's talk about silver, because silver has its own story and it is even more interesting. Silver is not just a precious metal. Silver is an industrial metal. It is used in solar panels, electronics, data centers, electric vehicles, medical equipment, and defense technology. In other words, silver is tied directly to the global energy transition and the global technology buildout. Industrial demand for silver does not disappear because interest rates go up for a few months. Industrial demand is driven by long-term infrastructure and manufacturing trends. So when silver drops sharply at the same time that industrial demand is still growing, what you are often seeing is not a collapse in demand, but a financial sell-off driven by liquidity and interest rate expectations. Silver often falls more than gold during these periods because silver is a smaller market and more volatile. But the important thing is this: if industrial demand continues growing while prices fall, eventually supply and demand push the price back up. Markets can disconnect from fundamentals for short periods. They cannot disconnect forever. Now we need to talk about oil, because oil is actually the most important piece of this entire story. Oil is not just another commodity. Oil is the input cost for transportation, manufacturing, shipping, agriculture, aviation, and logistics. Oil affects the price of almost everything in the global economy. When oil goes up, inflation expectations go up. When inflation expectations go up, central banks keep interest rates higher for longer. When interest rates stay higher, the dollar stays strong. When the dollar is strong, gold and silver often struggle in the short term. So oil right arrow, inflation right arrow, interest rates right arrow, dollar right arrow, gold and silver. This is the chain reaction that connects all three markets. And this is why you cannot look at gold, silver, or oil separately. They are part of the same system. This is also where institutional investors behave very differently from retail investors. Retail investors look at gold falling and think gold is a bad investment. Institutional investors look at oil, inflation expectations, bond yields, and currency movements and understand why gold is falling. Retail investors react to price. Institutional investors react to the mechanism behind the price. This is one of the biggest differences between amateur and professional investing. Professionals are not trying to predict tomorrow's price. They are trying to understand the system that moves prices. Now let's look forward, because markets are always looking forward, not backward. The most important question right now is not what gold did today or what silver did today. The most important question is what happens to oil over the next few months. If oil continues rising sharply, inflation expectations stay high, interest rates stay high, the dollar stays strong, and gold and silver may remain under pressure in the short term. But if oil stabilizes or starts to fall, inflation expectations fall, interest rate cuts come back into the conversation, the dollar weakens, and gold and silver often begin their next move upward. So the direction of oil over the next 60 to 90 days may determine the direction of gold and silver for the rest of the year. This is why serious investors are watching energy markets very closely right now. Now let's bring all three of these stories together into one clear picture. Gold falling right now is not necessarily a statement about gold's long-term value. It may be the result of leveraged funds selling liquid assets to cover losses elsewhere and the impact of higher interest rates supporting the dollar. Silver falling right now is not necessarily a statement about industrial demand. Industrial demand from solar, AI infrastructure, electronics, and electric vehicles continues to grow, which means the long-term demand story may still be intact even if the price is volatile in the short term. Oil rising right now is the key variable connecting everything, because oil influences inflation, inflation influences interest rates influence the dollar, and the dollar influences gold and silver. So what looks like three separate market moves is actually one macroeconomic story, and once you understand that story, the price movements start to make sense. This is why in markets, price alone does not tell you the story. Price is just the final result of thousands of decisions made by investors, funds, institutions, and governments reacting to interest rates, currencies, inflation, and risk. If you only watch the price, markets look random. If you understand the mechanism, markets start to look logical. And this is really the big lesson from what just happened. The unthinkable did not actually happen. The system behaved exactly the way the system always behaves when liquidity tightens, oil rises, interest rates stay high, and leveraged money has to reduce risk. It only looks unthinkable if you're looking at markets through headlines instead of through capital flows and macroeconomics. So the real question is not whether gold went down today, or silver went down today, or oil went up today. The real question is whether you understand why. Because in markets, the people who understand the mechanism eventually make the decisions, and the people who react to price usually react too late. And that difference, more than anything else, is what separates investors who survive markets from investors who don't. See you in the next one.